No, not at all. I mean, on a long-term basis, it's nowhere near overdone. You had me on, I think, CNBC a while ago, and I put out this tweet on a few days ago saying, look, my base case is a recession, and during those recessions, the market goes down 35 to 50%. So that is the overarching view from a longer-term basis. Now, from a short-term basis, we went ahead and we started covering two shorts that we put on yesterday at the close. One's down 10% today. The other one's down 15% today. So from a short-term basis, I look at a couple of encouraging things. 10-year Treasury yields are not making new lows. Crude oil didn't undercut the old lows. Gold is down. The dollar is higher. And the utility sector, which I find really interesting, right? That's supposed to be a source of safety. It was down 10.2% today. That's down more than the S&P. So there was absolutely people getting carried out on stretchers today in the market, and that's probably one of the best indicators of that. So from a short-term basis, yes, but if the market rips up 4 to 5% over the next couple of days, I plan on putting those shorts all back on because we've already seen 3 rallies of 4 to 5% over the last couple of weeks, and we've gone to new lows. And so I think that's how you should frame this if you're thinking about this from a short-term basis versus a longer-term basis.
Charlie, I mean, where do you stand relative to what Dan said, that if we are now expecting a recession, that the typical decline could be as much as 50% from the peaks?
Yeah, but we've already incurred, I would argue, 25 or 26% of that. So I agree.
So do you agree we could go down another?
Yeah, that's why what I keep coming back to is the actual news and the actual facts. If this turns into a real downturn in consumer sentiment, people don't buy cars and go to the grocery store, and we get a recession, then absolutely earnings estimates are way too high and will have to come down. And so the market will have another tough period. I'm sticking with the possibility that we've seen in other countries that we could see this bad news could crest in a relatively short period of time, which I'm going to define as 4 to 6 weeks. And if that happens, so far consumer confidence has not been crushed by this. There's been no upturn. We had a very good job number. We are not seeing signs of layoffs yet. So I am not sure we are going to have a recession come out of this. If we do, then he's absolutely right. I'm still holding out hope that we can get to the other side of this in a relatively short period of time.
And whether people will adhere to this or not, there was a time going back a couple of weeks when it seemed like a long shot bear call when folks said, well, if the S&P gets down toward those December lows, that's kind of a close your eyes and buy type level, just because so far, so fast, you're dialing back a year and a half to a moment when it did prove to be a good buy. Now, there's nothing magic about those levels, but I do think at a certain point, the pendulum just goes a little bit too far in the short term. The problem is you've gone down in such a straight line that you can rally literally 10 or 12% from here, and you would look at that chart and say, well, that's nothing. That's just a bounce in a downtrend. So that's where you get into a little bit of a dicey tactical situation.
Dan, where do you stand specifically on Apple stock at the moment?
That's one of the ones I shorted yesterday at the close and covered today. Here's the biggest thing I look at right now for every company is what does your balance sheet look like? And the good news for Apple is Apple's got a terrific balance sheet. But if you remember our view on Apple, this was, we put this tweet out on February 10th, where we talked about the fact we were starting to short Apple. And then on the 17th of February, we put out a tweet saying with 50% of our assets were now short Apple and their suppliers. For us, that pre-announcement, that was no surprise. The good news is from a short-term basis, you look at Apple and you say, okay, yeah, it can probably bounce because it has a rock-solid balance sheet. But from a longer-term basis, the valuation's still near decade high. Why on earth would you buy Apple from a longer-term basis? Because the valuation still does not discount the risk that you're dealing with. I mean, these guys sell $1,000 iPhones. How many people do you think today feel rich enough where they want to run out and spend $1,000 on an iPhone? Because they're not selling $300 5G phones. There's other names. I mean, we like the gaming stock. Like, we will add more to those when they come in, like an Activision, for example. Because we look at that and we say, look, people are going to be at home. They need to entertain themselves. That's the stuff they're going to do. And you have a real super cycle in that you haven't had a new gaming system for 7 years. and yet both Microsoft and Sony putting out their last hardware console cycle. That's a real super cycle, not a new iPhone
especially
every year.
when you have kids whose schools have been shut down for 6 weeks. You know that there's going to be yeah, exactly. It's a great point. Dan?
My kids, I just got the thing this morning that University of Chicago, their next semester, it's all online. It's at home. I just got that today. My kids are coming back. They won't be going back. So that's, unfortunately, my kids love to play video games. They'll be playing a lot more of them, I'm sure.
Yeah, they're supposed to be an online class, but whether they're on Activision or Nintendo or Sony or whatever.
But Dan, just to clarify, because Contessa had a wry smile, the gaming stocks you're buying are not the casinos, not Contessa's casinos.
No, not casinos. I'm talking like names like Activision, Zynga, Take-Two. Those, I should have made that clear. My apologies. But those are the names.
No.
And then
it was clear. I was getting ready to press you on when Las Vegas Sands, but you've made that perfectly clear. Dan, thank you for that.